The law of capital multiplication states a fundamental truth of speculation that most traders ignore. True, sustainable account growth requires exponential scaling, not the linear plodding addition of small disconnected wins. You must leverage your winning position to build capital, allowing the market itself to become your biggest partner in expansion. Never mistake increasing position size with every trade, which is merely additive scaling, for the concept of true compounding, which is multiplicative scaling. The amateur believes that placing more capital on every subsequent entry will lead to faster growth. This is simply a recipe for increasing risk exposure without the market's crucial validation. True compounding only occurs when the market confirms your initial judgment, allowing you to increase size on the back of existing profit. Pyramiding is the only sophisticated mechanism that transforms single, well-chosen winning trades into capital multiplication events. It is the process where you allow the initial success to fund the subsequent scaling. The pyramid structure forces you to utilize your unrealized gains, thereby minimizing the exposure of your core initial trading capital. It is the mechanism that separates the consistent speculator from the gambler. The primary error in scaling is confusing the disaster of averaging down with the success of true pyramiding. Averaging down is the emotional trap of adding to a losing position, doubling the mistake. This action is rooted in hope and ego, not in market reality. True pyramiding, conversely, is the highly disciplined action of adding only to a position that is moving consistently and confirming the original thesis. Successful pyramiding relies entirely upon a strict, uncompromising adherence to rules that govern total risk exposure and confirmation metrics. Without these parameters, the act of scaling simply becomes a high-risk gamble guaranteeing future ruin. The market does not reward hope. It only rewards rigorous planning and flawless execution of that plan. I have seen fortunes made and lost on this principle alone. Law 1. Only pyramid into positions that are already exhibiting significant floating profit, validating the initial hypothesis. The market must first prove you correct before you risk a single additional dollar. Do not rush to add units the moment a trade moves slightly into the green. Patience is your required capital. The floating profit acts as a protective buffer, absorbing the initial shock should the market immediately reverse after your addition. This buffer ensures that you are trading with the market's money, insulating your initial risk capital from unnecessary exposure. Never chase a move that has not fully established its credentials. The price action must be decisive and unequivocal, clearly showing the line of least resistance is in your favor. Only a confirmed, profitable trade deserves more capital. Anything less is speculation against the tape. You must wait for confirmation. The trade must earn the right to your larger commitment. The strength of the move is the only signal that matters. A validated position is a profitable position, and only profit can fund growth. This discipline eliminates the common amateur error of scaling into a losing fight. You are not a hero, you are an opportunistic speculator. The profit must be clear and significant. Only then do you act. Law 2. Define the maximum tolerable capital exposure, total risk, before the first unit of the trade is ever entered. A trade begins with its end in sight, specifically its maximum potential cost. Before you commit the first dollar, you must know the ultimate total position size you are willing to hold, regardless of how many steps it takes. This means calculating the total risk capital allocated to the entire pyramid from the beginning. You are planning the campaign, not just the first skirmish. The risk is managed by the calculation of the final aggregated stop loss. Knowing the full risk up front prevents the emotional panic that occurs when a position becomes too large too quickly. Your total exposure must never exceed your predefined risk tolerance, which often means allocating a smaller initial unit to allow for 3 or 4 subsequent additions. The temptation to front-load the risk is the mark of an amateur. The professional begins small but plans big. The plan must dictate the size, not the emotion of the market movement. Never let a single opportunity compromise your total account safety. This rule is the bedrock of systematic speculation. You must trade with a disciplined mind. The predefined maximum exposure acts as a psychological stop-loss for your entire strategy. Law 3. Confirmation must occur at logical technical pivot points, never arbitrarily based on minor price movement. Do not add to a position simply because the price has moved up a specific number of ticks or points. Your additions must be justified by structural market confirmation. This means adding when the price successfully breaks a key resistance level and perhaps retests it as support, or when a major structural low is definitively broken. These points represent a new, higher level of market commitment. They are the market's clear signposts that the original trend is accelerating. Adding units based on noise is a guaranteed path to ruin. You must wait for the decisive movements, the structural shifts that prove the momentum is sustained. The market is constantly moving, but only key pivots define the trend's trajectory. A successful addition requires a successful technical break. This forces you to scale only when the evidence is overwhelming, not when the movement is merely convincing. The difference is discipline. Your addition must be a logical reaction to a definitive change in the market structure, not a preemptive guess. The market will always tell you when it is ready. You must simply learn to listen to the right signals. Law 4. Subsequent additions must always decrease in size relative to the preceding position, diminishing unit size. This is the core principle that gives the strategy its name, the pyramid. The initial entry should be the largest unit, and each subsequent addition must be smaller than the one that came before it. This structure protects the blended weighted average price WAP. By reducing the size of later units, you ensure that a reversal from the peak does not immediately wipe out all accumulated profit. The largest commitment should always be made closest to the initial entry price. This mathematical certainty ensures that your average cost moves up slower than the price itself. This preserves the distance between the market price and your critical aggregated stop-loss. Never invert the pyramid. That is the strategy of the doomed. The diminishing size acts as a necessary constraint on your ego. It prevents you from becoming over-leveraged at the highest and most vulnerable point of the trend. This discipline guarantees the stability of the entire position. A smaller unit at the top adds less risk and maintains a healthy profit buffer. Always protect your WAP. This is the difference between multiplication and annihilation. Law 5. Position sizing for additions must be calculated against unrealized profit, insulating the initial margin. The capital for each additional unit must be drawn conceptually from the floating profit of the existing position. This is the only way to genuinely leverage the market's momentum without unnecessarily escalating your core capital risk. You are using the market's gift, the floating profit, to fund your expansion. You are trading with the house's money. This insulation is a non-negotiable principle of financial survival. The core capital committed to the first unit must remain secure. Only the unrealized profit should be considered available for scaling. This shifts the psychological burden. You are not risking more of your own initial funds. You are risking only what the market has temporarily granted you. This method provides an undeniable psychological advantage, allowing for clearer, more objective decision-making. You must view the unrealized profit as a separate fund dedicated solely to expansion. If the profit is not sufficient to fund the next, smaller unit, then you are not yet ready to scale. Wait for the market to generate the necessary funding. This rule forces patience. Law 6. Adjust the stop-loss after each addition, ensuring the average entry price maintains a protective buffer against capital loss. Every time you add a new unit to the pyramid, your total aggregated risk profile shifts. It is absolutely mandatory that you immediately move your stop-loss higher in a long trade to compensate for the higher weighted average price. The ultimate goal is to move the aggregated stop-loss to a point where the entire position is at a guaranteed break-even, or ideally, locks in a portion of the profit. This locks in gains. Never allow a profitable trade, no matter how scaled, to turn into a net loss. That is the cardinal sin of speculation. The adjustment must be immediate, calculated, and executed without hesitation. If the market reverses, your predefined exit point must protect the bulk of your capital. This is not about letting the position breathe. It is about protecting the capital you have fought to accumulate. The new stop-loss must always respect the market structure while simultaneously defending your accumulated profit. It is a dual responsibility. This proactive management separates the professional from the hopeful amateur. Your stop-loss is your insurance policy against the unknown. Law 7. Pyramiding is reserved exclusively for primary trend impulse waves, never during corrective or choppy phases. Pyramiding is a strategy of momentum and expansion. It is completely useless and actively dangerous in consolidating or sideways markets. You must identify the clear, persistent primary trend, the wave of least resistance, before attempting to scale. An impulse wave is characterized by high volume and decisive price movement in the direction of the trend. Corrective phases, conversely, are volatile, lacking clear direction, and defined by indecision. Scaling into correction or chop will lead to your additions being stopped out one after another, eroding your profit and your confidence. The market must be moving with conviction. Look for clear, strong directional movement that breaks previous highs or lows with authority. This confirms the trend's health. The primary trend is your friend, but only during its explosive periods. If the market is confusing, it is telling you to stay out. Do not attempt to force a pyramid into a market that is not ready to run. Pyramiding is catching a train already in motion, not building the tracks. The energy of the impulse wave is what powers your scaling strategy. Without that energy, your position will stall and likely reverse. Wait for the run. Law 8. Utilize momentum indicators, e.g. MACD expansion, to quantify the strength remaining in the movement before scaling. Blindly adding units based only on price is incomplete and reckless. You must look beneath the surface to gauge the internal engine of the movement. Momentum indicators provide this crucial quantification. An expanding MACD or a strong RSI that is not yet overbought suggests that there is sufficient fuel remaining for the trend to continue. A decelerating momentum indicator, even with minor price movement, is a clear warning sign. It suggests the movement is losing steam and that a reversal is imminent. Scaling into a weakening momentum is equivalent to sailing a ship into a dying wind. You must ensure the market has the necessary energy to carry your increased position size further. The indicators must confirm the price action. They are the gauges that tell you the pressure is still building. If momentum is fading, you must cease all scaling immediately. You are a trend follower, and the trend's health is measured by its internal strength, not just its current position. Momentum is the validation that the large capital is still driving the move. Do not ignore the market's engine room. Law 9. Scaling points must align with retests of key structural levels, such as broken resistance becoming support. The most reliable points for an addition are those moments when the market confirms a change in its structural function. When price breaks resistance and subsequently returns to successfully test that former resistance as new support, this is a powerful confirmation signal. It shows institutional conviction. This specific market behavior, the structural flip, is a high probability entry point. It reduces the risk profile of the addition significantly. These retests are the market's pauses, where it gathers energy before the next push. Adding during a successful retest means you are scaling in at a confirmed lower risk location. Do not chase the breakout. Wait for the successful retest. This forces the market to prove its conviction before you commit more capital. It is a waiting game, and patience is your edge. The alignment with structural retests ensures your additions are based on logic, not emotion. This is the difference between a high-risk gamble and a calculated increase in exposure. Trust the structure. The market leaves breadcrumbs. You must simply find them. Law 10. Predefine the ultimate price target and the maximum allowable drawdown for the aggregated position before initiating entry. Every trade must have a purpose, an ultimate destination. Before you enter the first unit, you must have a clear, realistic expectation of the final price target. Furthermore, you must define the maximum percentage drawdown you are willing to tolerate for the entire aggregated position before you liquidate everything. This level of pre-definition removes emotion from the exit strategy. You are not guessing where the market will stop. You are simply defining your maximum tolerance for reversal. The profit target gives the pyramid its reason for being. The maximum drawdown acts as the final emergency brake. You must know your absolute limit. If the market approaches the ultimate price target, you must be prepared to cease scaling and begin realizing profit, regardless of momentum. The purpose of speculation is not to be perpetually right, but to realize profit. Predefining the exit is just as important as defining the entry. This framework ensures that greed does not blind you at the top of the move. Trade the plan, not the hope. The plan is your discipline made manifest. Law 11. Continuously calculate and monitor the blended weighted average price, WAPE, of the entire accumulated position. The weighted average price is the true cost of your entire position. It changes with every addition you make. You must know this figure at all times. This WAP is the critical point that must be protected as it defines your break-even level. Knowing the WAP allows you to precisely manage your aggregated stop-loss. If you lose track of your WAP, you lose control of your risk. This is a cold mathematical discipline, not an emotional exercise. The WAP provides the necessary distance metric for your stop-loss adjustments. If your WAP is too close to the current market price, your position is fragile and overextended. The market can wipe out your gains with a single sharp reversal. Monitoring the WAP prevents this deadly complacency. It forces a continuous recalculation of your true exposure. The blended WAP is the reality of your position. Everything else is noise. You are trading numbers, not tickers. Keep the WAP firmly in mind and manage the distance between it and the market price ruthlessly. Law 12. Ensure that every added unit improves the overall aggregated risk-to-reward ratio, never diminishing it. The primary objective of pyramiding is to leverage an excellent risk-to-reward profile from the initial entry into an exponential profit. Each subsequent addition must be evaluated against this core objective. A well-placed addition must not degrade the overall reward potential relative to the remaining risk. If an addition is placed too far from the final target, or if the stop-loss adjustment is disproportionately large, the risk-to-reward ratio of the entire position suffers. This means the addition was poorly timed or sized. Only add when the remaining potential profit significantly outweighs the potential loss from a reversal. This forces mathematical rigor into your scaling decisions. You are seeking optimization, not merely size. Never add a unit that weakens your overall mathematical position. The professional speculator demands a healthy risk-to-reward for every dollar committed. If the ratio diminishes, the opportunity has passed. Wait for the next validated move. Discipline must be the foundation of your mathematics. Law 13. Limit the depth of the pyramid to 3 to 4 scaling steps. Excessive steps introduce fragility and complexity. The market is not a precise machine. Every addition increases the complexity of management and introduces a new point of failure. A pyramid should be deep enough to multiply capital but shallow enough to remain easily manageable. I have found that 3 or 4 well-placed, diminishing units are the optimal balance. Beyond this depth, the blended WAP becomes too close to the market price. The position becomes overly sensitive to minor reversals. Excessive steps lead to fragility. They make the entire structure prone to collapse under the slightest pressure. Keep it simple. A complex position is a losing position waiting to happen. Focus on making the 3 or 4 entries perfect, validated, and highly profitable. Do not attempt to catch every fraction of the move. Leave the minor fluctuations to the market noise. Your goal is the large movement, and the large movement is best captured with a constrained number of perfect additions. Simplicity breeds clarity and control. The professional avoids unnecessary complexity. Law 14. Never add to a position when oscillators signal extreme overbought or oversold conditions, indicating potential exhaustion. Price action can continue long after an oscillator screams overbought, but that signal is a critical warning. Extreme readings suggest the trend is entering its final, exhausted stage. Adding new capital at the point of maximum excitement is a fundamental error. This is where the retail crowd piles in, and the smart money begins to distribute. You must be selling into this exhaustion, not buying into it. The oscillator is a psychological thermometer for the market. A reading that suggests extreme extension signals that the remaining upside potential is minimal, while the downside risk is rapidly accelerating. This dramatically degrades the aggregated risk-to-reward ratio. Your pyramid must be built during the early and middle stages of the trend. Avoid the climax. The final push is too risky for new capital commitment. The market often takes a breath after exhaustion. That breath can quickly become a deadly reversal. Respect the signs of fatigue. Law 15. If volatility decreases or price enters a narrow range after an addition, immediately cease all further scaling attempts. Pyramiding is driven by volatility and momentum. A decrease in market volatility, or the price entering a tight consolidation after a period of decisive movement, is a clear signal that the energy is draining. The large capital is no longer pushing. Further additions in a low volatility, narrow range environment are a waste of capital and expose you to unnecessary risk. The position will simply stall, and time decay will begin to erode your advantage. You must wait for the volatility to resume in your favor, or you must simply cease scaling and manage the existing position toward the ultimate target. A market that is resting is a market that is preparing to move. You do not know which way. Do not force an entry into this ambiguity. Ceasing the scaling process requires discipline. You must recognize when the conditions for multiplication have ended. Preservation of capital becomes the primary task at that point. The market must demonstrate its intention. If it is silent, you must be silent too. The law of pyramiding is fundamentally the law of risk management applied only to demonstrated winners. It is the framework that allows you to take maximum advantage of a correct judgment while strictly limiting the capital at risk. You are not scaling risk. You are scaling confidence, backed by market evidence. The market rewards risk managed with cold logic. Embrace the mindset that initial entries should be small probes designed primarily to validate the trade idea, not to maximize initial profit. Your first unit is simply a scout, a minimum commitment to test the market's true intention. It is an exploration. If the scout reports back with positive news, that is profit, then, and only then, do you commit the larger battalions of capital. True pyramiding demands meticulous discipline and patience, contrasting sharply with the aggressive ego-driven urge to force entries. The amateur wants to be all in immediately. The professional wants to be all in only when the market has proven it is ready to run. You must eliminate the ego that demands immediate, maximum leverage. Patience is the cost of entry to the highest ranks of speculation. Implementation rule. Master the entire technique using paper trading or minimal lot sizes until all 15 laws become instinctive, second nature reflexes. Do not risk meaningful capital until this complex discipline is burned into your mind and execution. Speculation is a performance skill. You must rehearse the performance until it is flawless. Final verdict. Multiplication of capital is reserved only for those traders who adhere to the strict, counterintuitive discipline of scaling based on market confirmation, not hope. If these words hit you, it means you're not here by accident. Subscribe now, like this video, and leave a comment. That simple action helps more people find this content, and it tells me that my work still matters. But the battlefield of the market is the mind, not the chart. If you want to understand the true psychology of speculation, you must read the one book that defines the game. I'm talking about Reminiscences of a Stock Operator. It is not historical, it is a permanent education in human nature and market cycles. The book is pure truth. Get your copy today. The link is in the description below.